There is one number that professional investors check before buying almost any stock. It takes 5 seconds to find. Most beginners have heard of it, but very few understand what it actually means. That number is the PE ratio. And by the end of this video, you will know exactly how to use it to evaluate any stock in the Indian market. Welcome back to Market Mindset, where we break down the stock market clearly, honestly, and without the noise. We post every Tuesday, Thursday, and Saturday. Today, we're covering one of the most fundamental concepts in investing, the price to earnings ratio. Understanding this single number will change how you look at every stock price from this point forward. So what is the PE ratio? PE stands for price to earnings. It answers one simple question: how much are investors willing to pay for every rupee of profit a company earns? Here's a concrete example. A company earns 10 rupees profit per share. Its stock trades at 200 rupees. Divide 200 by 10. You get a PE ratio of 20. This means investors are paying 20 rupees for every 1 rupee of profit. That's it. Nothing more complicated than that. The PE ratio is simply a measure of how expensive or cheap a stock is relative to what the company actually earns. How do you calculate it? The formula is share price divided by earnings per share. Earnings per share is the company's total profit divided by total shares. You don't need to calculate this yourself. Screener.in, Money Control, and NSE India all show PE ratio directly on every stock page. But understanding the calculation means you understand what the number represents. And that's what matters. What does a high PE mean versus a low PE? A high PE, say 50, 60, or 80, means investors expect the company to grow rapidly in the future. They're not just paying for today's profits, they're paying for tomorrow's potential. Technology companies and fast-growing businesses typically have high PE ratios. A low PE, say 8, 10, or 12, could mean the stock is cheap and undervalued. Or it could mean the market expects earnings to fall. Low PE is not automatically good. High PE is not automatically bad. Context is everything. How do you compare PE ratios? Only compare within the same sector. Comparing a bank's PE to an IT company's PE is meaningless. Different industries have different normal ranges. Banks typically trade at 10 to 20. IT companies often trade at 20 to 35. Consumer goods sometimes trade at 40 to 60. Compare a company's current PE to its sector peers and its own historical average. If HDFC Bank's 5-year average PE is 25 and it's currently trading at 18, it might be undervalued. If it's at 35, it might be overpriced. Screener.in shows historical PE for any Indian company. Now, the 3 mistakes investors make with PE ratio. Mistake 1, buying a stock purely because the PE is low. A low PE can mean cheap. It can also mean the business is struggling or earnings are about to fall. Always ask why the PE is low before assuming it's a bargain. Mistake 2, avoiding stocks with high PE ratios. Some of the greatest wealth-creating stocks in history had PE ratios above 50 when they were at their best buying points. Infosys, TCS, Asian Paints all had high PE ratios for extended periods while delivering exceptional long-term returns. A high PE is only a problem if the expected growth doesn't materialize. Mistake 3, using PE ratio alone. The PE ratio is one tool, not the whole toolkit. Always combine it with revenue growth, debt levels, return on equity, and sector context. No single number tells the complete story. So to summarize, the PE ratio tells you how much investors are paying for every rupee of company profit. High PE means growth expectations. Low PE means either value or risk. Always compare within the same sector and against historical averages, and never use it in isolation. In Thursday's video, we applied this exact concept to reading a company's balance sheet. Watch it next if you haven't already. Subscribe to Market Mindset. We post every Tuesday, Thursday, and Saturday. Drop a comment. Which stock do you want analyzed using PE ratio? This is educational content only. Do your own research before investing. See you Tuesday.